Hey there, and welcome to another episode of Know Before You Owe. I'm Brian Parker with Monarch Mortgage. Today we're talking about calculating debt to income ratios in terms of qualifying for a home loan. Let's start with a few caveats. I found you an online calculator here at Zillow, which can give you a general idea of what you may qualify for. But there are several caveats we're going to go through here very quickly before we talk about debt to income ratios. One is your annual income and qualifying income. In this scenario, it shows $120,000 annual income, assuming household or individual. It's just this scenario. But it's also going to assume that this is a salary individual or a salary household. If you or anybody on the loan that is qualifying receives hourly income, bonus income, overtime, shift differential, tip income, you might be a over-the-road driver, long hauler that you get mileage reimbursements, etc. All of those types of income become variable income, and each one gets calculated differently for a mortgage lender. So what you may see in your paycheck or in your W-2 may not be exactly what we as a mortgage lender can give you credit for in qualifying. So if any of that applies to you, I urge you right now to throw this calculator aside and give me or your local mortgage professional a call and start looking at it the right way. The other caveat in that is in your liabilities. Now, your credit card payments is shown here, assuming you've got $200 a month for your credit cards. You got a $500 a month car payment. That's going to be whatever shows on your statement and in your credit report. But student loans are different. You may have a zero repayment plan on your student loans. You might have an income-based repayment plan, but that may not be the payment that the mortgage lender has to use to qualify you for what that monthly debt may be. And that can vary depending on the type of loan you're trying to get, whether it's a conventional loan, FHA, VA, USDA loan. So again, if student loan payments are in your qualifying of your ratio, throw this calculator away right now and give your mortgage professional a call. If you pay or receive alimony or child support, that factors in your qualifying. If you have second home or investment property expenses, that factors in your qualifying. But other expenses that typically you may pay outside that are just kind of monthly expenses that are not in your credit typically will not apply. But hold fast right there and make this note. If you are the generation that uses different app for bill pays, if you use Cash App, stuff like that, if you use Venmo a lot, if you use Zelle a lot, when we review your bank statements and we see recurring payments to certain entities or individuals that may not reflect in your credit report, that could factor against you in qualifying. So if that is something that is what you do, again, stop right here and call your mortgage professional. Now, let's go back to the calculator and just say everything that's in these numbers here is exactly true and accurate and nothing else applies to you. That means your total monthly debts that are in your credit report and everything total $1,000 a month. And if the maximum qualifying ratio is 45%, that means you can qualify for a mortgage payment, principal, interest, taxes, and insurance, mortgage insurance if applicable, and also any HOA dues if they're associated with the property, up to $3,490 per month. Now, if I'm using 45%, why am I doing that? Because pretty much every conventional loan, and specifically any loan that may have assistance tied to it for down payment assistance, grants, funds, That's going to cap you out in most cases at a 45% DTI. There are a few loan programs that will let you exceed that, an FHA loan and a VA loan, but there also are some loan programs that will not let you exceed 43% or 41%. Some are even like 33%. So again, to know what your true qualifying situation is, talk with your mortgage professional. So this is an easy tool to give you an idea to find out what you can qualify for. But if any of the caveats that I spoke about regarding income, student loans, alimony or child support, if you have secondary or investment property expenses, if you schedule in your tax returns, if you have a Schedule C, where you have a side hustle, a side job, where you get 1099 income, if you file a Schedule E, where you have rental property, maybe you're like me and you grew up with a family on a farm and you have farming income, which is a Schedule F. That can affect you as well too. So I hope this is helpful for you, but please take note. This is just a roadmap for you. Please get in touch with your mortgage professional. I'm Brian Parker. You can find me at brianparkergroup.com.